Hi, welcome to the Devon client webinar. It's the first for 2023. Hard to believe we're in February, but be it as it may. Joined here today by MD and Portfolio Manager Slade Robertson. G'day, Slade.
Hey, Greg, how are you? Yeah.
Excellent. And of course, Tama Willis, fresh from actually Breakfast TV this morning. How are you going, Tama? Right?
Going well, thanks, Greg.
Early start. Hey, great to have you both along. Great to have everyone here, and see you into the new year. So we're just going to go through how the guys sort of see things as we start a new year, and just talk about a couple of topics. Just starting with you, Slade. Actually, we have to mention things have been working pretty well. We've already received some recognition, nominated for Fund Manager of the Year by Morningstar in their awards. Obviously, 2022 was a great year, but January started off very well as well. Good performance. What's working well, and how do you see things from here? So the same sort of formula being applied?
Yeah, look, thanks very much, Greg, and thanks everybody for listening in today. Look, I think so. It's, if I think back as to how last year played out, it was a year which was very much dominated in terms of investment thematics by top-down macro themes, including sort of inflation and principally how central banks were responding to the threat of inflation increasing at a rate that they couldn't control. Our view towards the back end of last year, and we did talk about this, was that we saw that there was evidence of transitory influence on some of those inflation numbers, and we expected that as we progressed through calendar year 23 that we would see those numbers coming down. And we anticipated that central banks would need to respond in a way which was consistent with that dynamic. Now, that has played out, and what we're seeing now is a market which is being underpinned by, I think, a level of growing comfort that this year won't be dominated by central banks looking to just withdraw, further and further stimulus within the economy, and therefore having an impact on growth and demand and the sort of factors that really do affect, top line outcomes for the businesses that we own. So I think, what really worked well for us last year, and I believe will be a big factor going forward to this year, is that, we very much have a process which is focused on bottom-up fundamentals. I'm extremely lucky to work with people like Tama, who's very talented in terms of his corporate analysis and the way that he looks at businesses, and almost sort of blocks out a lot of that noise that goes on, from a top-down perspective within markets, and that enables us to navigate some of these volatile times, I think, quite effectively. And what we do see in markets which are volatile like they have been, and I believe will continue to be so, is the ability to rotate in between sectors and companies which offer value and have the quality characteristics that we really like. At times when the market seems to ignore them, and we're able to sell those when they become sort of a hot topic, for investors at different stages of the cycle. So I think that's very much going to be the case as we move through this year. And you mentioned how this year has begun for us, and I think, both from a Devon perspective and from a market perspective, what you're seeing is that equities have rallied strongly already this year. And from a general perspective, lots of investors remain very bearish, and I think they've been very conservatively positioned going into this year. Cash balances are very high. People's expectations of the returns that can be expected within equities are quite low, and I think as a consequence of that, there's a lot of money still to be redeployed into equities if we start seeing the dynamics and the characteristics of that asset class improvement. We took the view back in December of last year that we saw a lot of really exciting opportunities appearing in some of the high quality cyclical names. We were about 2 to 3 weeks early with that view, and some of our returns weren't quite as good as we hoped for and we expected ourselves in December, but they came back, with real vengeance in January, as lots of those names got recognised by the market, and we saw quite a substantial re-rating of some of those names, such as your James Hardys, your Goodman Groups, these sorts of businesses. So now that's really exciting for us, and I think, as I said at the back end of last year, I anticipate that the next, sort of 3 to 4 months will be quite volatile in markets. We're about to go through an earnings season, which will be, and it's always characterised by, lots of good news stories and some not so good stories, and that lends itself to markets bouncing and prices bouncing around a bit. I think that'll be the case again. We're very fixated on making sure that we understand, which companies have positioned themselves to navigate some of the margin challenges that they'll face in this environment, and just making sure that we understand the valuations of all the companies, but looking for those where the market is being excessively conservative. the way in which they're pricing them. So yeah, no, I think it's going to be exciting. It's going to be, I think overall this year we'll see equity markets progress higher, albeit there'll be periods, in the short term where I think, those who are more bearish in terms of their assessment will feel vindicated. But I think we'll work our way through that noise, and during the course of this year, stock prices will finish in the positive.
Oh, fantastic! I think so. So yeah, productive environment still for active investors. That's great. Now, so you touched on the earnings season, so I might spin over to you, Tama. Actually, before I do that, I should also congratulate you. Trans-Tasman Fund has been also nominated for Manager of the Year. Probably should also mention that the yield fund is in there as well. Just for all the best with that. But yeah, just on the earnings season, we're about to get underway in New Zealand and Australia. What do you see as something that's emerging? What are you looking for?
And so it's fascinating. I mean, Australia, if you look across Australia, we've all travelled there in recent months, it is booming. And you've seen that reflected in what the RBA said yesterday around interest rates. They lifted, still well below New Zealand, but lifted rates to around 3.35%, and still signalling more rate hikes to come. Inflation's been a bit higher than New Zealand, and consumption's been very strong. So we talked a lot about last year around, household consumption would fall because of rate pressure and mortgage rates. Now we still haven't seen that really hit. So going into results season, we will be looking to see whether finally the consumer is showing signs of some conservatism or cautiousness as those mortgage rate hikes really come through and hit their spending power. We'll be looking for cost pressures, across the corporates, and margin pressure, which Slade talked about. Some businesses will be much better protected, and that's why we're investing in high quality businesses who can manage that margin, but it's an uncertainty, so we're watching that very closely. And then of course the earnings beats versus misses. How do these companies actually do the top line results meet expectations? We had Suncorp out this morning, which actually did a pretty good job of signaling things are looking better in the future, so they're doing okay. There'll always be a mix of outcomes across different sectors. The resources space has had stronger pricing on the China reopening. Market was very keen to hear about BHP's view, given they have a lot of people in China. How strong is the recovery? How long will it run for? The banks have got a lot of margin upside, and that's been markets very aware of that. Exactly how does that come through in the CBA results? So as always, there'll be a lot to look at. In New Zealand, we're a little bit ahead on slowing down than Australia. But we do have a lot of quality defensive international businesses, quality domestic businesses like the Gentailers. There shouldn't be too many surprises in the Sparks and the Gentailers, and we don't have that many retailers. So again, that we'll be watching each company to see how they perform.
Excellent. Just so another topic, quite topical, that in terms of M&A activity, we saw quite a few companies last year that were held by Devon Funds involved in either takeover approaches or full bids, and like Ramsey and so on. Now, we've already seen a bid in Australia, haven't we, with Newcrest, which has held some of the funds bid for by Newmont. Big deal in the gold sector. What's your take on that? And do you see M&A activity in other sectors over the course of the year? And what do you protect?
Yes, I mean, that's a good question. I suppose you're right that we did have quite a few of our companies, a number of our companies involved in M&A activity last year. Ramsey was the main takeover, bid by private equity for about a very, very good price, but it didn't actually complete. One of the reasons for that was as interest rates rose, debt costs became too elevated, and there were a few other challenges, but that was predominantly the main reason. Interest rates went from, in the US, low single digit, 1% to 3%, 3.5%. So that's to me that, and it also stopped a lot of other private equity takeovers. The ones that have actually succeeded, like the bigger ones, like Oz Minerals by BHP's cashed up, has a lot of surplus capital. In the case of, we didn't own Oz Minerals, but we do own Newcrest, and Newmont Gold, which is the largest gold miner in the world, has made a bid to Newcrest, all script bid. I think, with whether they have to improve it, it's possible. I think that's an example of a large corporate seeing good value in a business in Australia, and I think we'll see more of that this year, particularly if we get inflation under control and interest rates start to come down a bit in the next 12 months. Private equity have a lot of capital sitting on the sidelines and could look to deploy that capital. So that's not part of our investment case, but we do own quite a handful of businesses, I'd say, in our portfolios that we think are very undervalued that could be taken out.
Yeah, exactly. So this was symptomatic of a larger buyer seeing that value. Well, thanks for those insights there, Tama. Of course, you, Slade, as always. It's been great. So you look forward to another strong year, but congratulations once again on those recognitions. We'll leave it there, but we'll be back with another regular webinar very soon as well. But in the meantime, I'd like to wish you a good rest of the day. Thank you for attending, and we'll catch you again soon. Bye for now.